Understanding Judgmental Credit Analysis, an in-depth look. In the world of lending and credit management, judgments about creditworthiness can vary significantly depending on the methods employed by different financial institutions. One such approach is judgmental credit analysis, a technique that prioritizes human judgment over algorithmic evaluation. This article aims to explain what judgmental credit analysis entails, how it compares to traditional credit scoring methods, and its implications for both borrowers and lenders. What is judgmental credit analysis? Judgmental credit analysis is an evaluation method that relies on a lender's personal judgment instead of a standardized credit scoring model. In practice, this means that when a borrower submits a credit application, the lender assesses the application based on their expertise and past experiences with similar applicants. This method is particularly useful in complex cases where algorithms may not capture the nuances of individual financial situations. Key characteristics of judgmental credit analysis. Experience-based evaluation. Lenders who employ judgmental credit analysis draw from their own experiences to gauge an applicant's creditworthiness, leading to more personalized assessments. No automated processes. Unlike automated credit scoring systems, judgmental credit analysis is devoid of algorithmic calculations, which may overlook key qualitative factors. Traditional standards. This analysis pays attention to established credit assessment pillars, such as payment history, banking references, age of credit history, and other relevant metrics. These factors are weighed to produce an overall judgment about the applicant's creditworthiness. Who uses judgmental credit analysis? This method is primarily utilized by smaller banks and credit unions. These institutions often do not possess the resources to develop complex automated credit scoring systems or to hire third-party agencies for credit evaluations. As a result, judgmental credit analysis offers a more practical alternative for them. In contrast, large banks typically rely on automated systems to process the high volume of credit applications they receive daily. This systematic approach allows for quicker decision-making, driven by statistical data that assesses risk levels across numerous borrowers. Comparing judgmental credit analysis with credit scoring models. Credit scores explained. The most recognized credit scoring model is the FICO score, developed by Fair Isaac Corporation. This scoring system ranges from 300 to 850, with higher scores indicating greater credibility and lower risk to lenders. The FICO score, along with other scoring models like Vantage Score, takes into consideration various factors to calculate an individual's credit score, including 1. Payment history. Timely payments positively influence scores, while missed or late payments can generate significant penalties. 2. Total amount owed. The total balance owed in relation to the available credit limit can affect scores, commonly known as credit utilization. 3. Length of credit history. A longer credit history can indicate reliability, leading to a higher score. 4. Types of credit. A mix of credit cards, mortgages, and installment loans can contribute positively. 5. New credit. Frequent applications for new credit can signal risk, potentially lowering the score. Implications of credit scores. Credit scores play a vital role in the lending process. Those with scores below 640 are typically classified as subprime borrowers, leading to higher interest rates and stricter lending terms. Conversely, scores above 700 generally yield more favorable conditions, such as lower interest rates, thereby reducing the total cost of borrowing. The unique benefits of judgmental credit analysis. While judgmental credit analysis may come with certain limitations, such as potential bias or inconsistency, it does offer some notable benefits. 1. Personal touch. This method allows lenders to form a deeper connection with applicants, taking into account unique circumstances and financial situations that might not fit neatly into a predefined credit score. 2. Flexibility. Lenders can apply discretion and flexibility, offering loans to people who might otherwise be overlooked by traditional credit scoring systems due to inadequate credit histories or other factors. 3. Community orientation. smaller financial institutions often have a vested interest in their local communities. By evaluating individuals based on personal judgment, they can foster stronger relationships and support local economic growth. Conclusion. Judgmental credit analysis presents a distinct approach to assessing creditworthiness, contrasting starkly with traditional credit scoring models like the FICO score. While it is primarily utilized by smaller financial institutions, this method emphasizes human judgment and experience. With both advantages and drawbacks, understanding judgmental credit analysis can help borrowers navigate the lending landscape, especially in a world where personalized financial service is becoming increasingly valuable. As the marketplace continues to evolve, this approach may play a crucial role in ensuring financial accessibility for a broader range of individuals.